Okay. Good morning, everybody. We had a couple more people join. Um, Maybe we'll see some more as we go along because there was a bunch of people that registered. But that's okay. If everybody's ready, we will get started. It's very strange to just be talking to myself. This is my first webinar, so you know, if I seem crazy or really weird on this, just let me know later. The chat is open for everybody to use. So if you have questions, go ahead and stick them in there. And what we're going to do is we're going to go through the presentation, and then when we get to the end, we will go through all of the questions that everybody has, and we'll get into some detail with uh, specific questions or whatever it is that you guys are interested in talking about. So, with no further ado, as long as everybody can see my screen, which it looks like we are, um, we're going to go ahead and get started. So, thank you for joining us today. If we haven't met, I'm Ryan. I'm the owner of Accent Financial Services, and I'm the biggest nerd in the company. So, we're happy to have you here. Today, we're going to be talking about year-end tax strategies. We've got a whole bunch of them. I think there's about 25 of them that we're going to go through. So we're gonna we're gonna not spend too much time on any one in particular, just so that we can get through all of the stuff that's out there. And then towards the end, again, put your questions in there, and we can go back and revisit some specifics if you'd like. In addition to being the owner of the company, I'm also a Main Street certified tax advisor, which means that I have been through a whole bunch of training to understand how to use tax laws and to bring them all together in a way that, we can help people use the rules to save money. And to get that certification, I it was a lot of courses that I did. I think there was a little bit more than 70 different tests that I had to do on different strategies and being able to put everything together. So it was not come by lightly. And I understand this stuff a lot more than your regular run-of-the-mill tax preparer. So with that said, here's what we're going to be talking about today. So we're going to go through retirement contributions, business strategies, charitable and personal strategies, family and estate stuff, and then just kind of some mishmash. Some of these things are going to, obviously connect to each other, um, but we'll try to get through it all as succinctly as we can, and then we'll get to your questions at the end. So, so why are we doing this, and why are you guys here? I think obviously you're looking to save some money, and that's really what our mission in all of this is too. In particular, for the end of the year, there's time sensitive stuff, right? Like if you're going to set up accounts, or if you're going to set up a business, or you want to do certain things, you want to do gifts, it has to be done by December 31st, right? And there's some things that can get pushed back from that. But for the most part, the reason that we're talking about this now is because we've got a month to do any of these strategies. So, in addition to, trying to reduce your tax liabilities for the year, we're also going to, we're going to talk about some of the things that exist as they do now, but we also understand that for 2025, there's a bunch of things that are probably going to be changing. So, um, I think everybody here is probably on the newsletter already. If you're not, we'll have a link at the end. We also have a YouTube channel, and we will be doing updates for people as new tax laws and new strategies come about, and we learn more about what's changing in 2025 and the future. We'll put out educational stuff to everybody, and strategies and ideas and stuff. So make sure you join us for all of that. So we're going to start off with retirement contributions. And, the reason that this is important is you've got you have limits that you can do for each year. And once the year passes, you can't go backwards and go put in that money again. So for instance, with your IRAs, you can only put in $7,000 a year. It's 8,000 if you're over 50, right? There's special rules. But the Roth IRA in particular is one of our favorite accounts to use. And it has huge advantages, but the big disadvantage is that you only get to put in so much money per year. So go put it in, right? Like this is the last month that you have in order to go fund these different things. Now, a 401k and an IRA, those two things are going to give you tax deductions, right? And so if you're looking for tax savings for this year, your traditional 401k and your traditional IRA are the things that are going to reduce your deductions for this year. There's limits for those. So the 401k, your limit is $23,000. If you're over 50, it's $30,500. If you have a business and you can pull off a solo 401k, so that's something that you would set up where it's a company where you are the only employee or you and your spouse are the only employees. And you can set up a 401k account for your company specifically. And your company can contribute more to your 401k than you're allowed to do just by yourself. So the maximum for this year is as an individual person, $69,000 you can contribute between your 23 from your paycheck and all of the extra money that the company can contribute for you. This leads into a pretty cool strategy called a Roth IRA, a backdoor Roth IRA. And if anybody wants to get into this, we're going to have some more content coming out about this. And it's a really, really strong strategy. And if you imagine, if you have the cash flow in your company and it's just you and you can employ your spouse, you can double this and you guys can put in all of this money into your 401k and then turn around and drop it into a Roth IRA through a backdoor Roth IRA. There's a special process to do that. And you'll end up paying the taxes on it for this year, but you'll never pay taxes on that money ever again. It's going to grow tax-free and it's going to come out tax-free. And so just when you're thinking about retirement stuff, you have to remember kind of the rules of these things. So the traditional 401k and IRA is you're not paying taxes on it now. You're deferring the taxes until later. On a Roth IRA, and there's also Roth 401ks, you're paying the taxes on it now, but it's going to grow tax-free and you won't ever pay taxes on it again. And there's different reasons for using these different things, and you can actually kind of make them all come together. And if anybody wants to talk about that a little bit more, we can get into all of that another time or with your specific situation. So business owner strategies. One of the things that everybody talks about, like, hey, I was thinking, should I go buy a car right now? Can I go get a new truck before the end of the year just so I can save money on taxes? And so my first reaction to that is, do you need a new truck? Because don't go buy things that you don't need just so that you can save money on taxes. But if you do need it, then great. We can work with that, and you should be able to take bonus depreciation on some of that equipment, vehicle stuff that you're buying towards the end of the year. But do remember, sometimes it takes some time to buy stuff, and you've only got the rest of this month to do it. Another good one for businesses is prepaying. Yeah, I just noticed you guys can see my little bubble going around. Maybe I'll stop moving that. Prepaying expenses. So most businesses are operating on a cash basis accounting system, which means when you get the money in your bank account, it counts as income. When the money goes out of your bank account, it counts as expenses. Well, if you wanted to prepay some things and have that money come out of your bank account in December, that counts towards your 2024 expenses. All right. Sorry about that again. Wow. Losing some steam here. Okay, so we were talking about prepaying expenses. So it is one of those things where, I'm sure you all get emails from the companies that you have like monthly subscriptions to and everything. It's like, hey, pay for the whole year and you'll get 15% off or something. Um, this is one of those times where you could do that because you'll be able to get all of that expense into December and reduce your tax liability for this year, right? Um, you can also do the same thing. So you're talking about changing when you're recording stuff, right? And with expenses, you're changing it by moving it forward. You can do the same thing with income and move it backwards. So say you have a company that you're expecting they're going to give you a check for $10,000 to pay for your services. You can say, hey, listen, can you pay me in the first week of January? Right. And if they do that, the rules for recording that income is now January income, and you're not paying taxes on it for 2024. Um, it is important though, because there is a small caveat that comes with that. If somebody gives you a check and says, here you go, here's payment for your services or your products or whatever it is, you can't just hold on to the checks. That's one of the things that the IRS particularly frowns on. In fact, in some of their examples, they include it as tax evasion. So if somebody does pay you, don't just hold on to checks. Okay. Um, the other big thing that you could and should do as a business owner is hold a board meeting. And the coolest part about the board meeting is you get to decide who's on the board for your company. You get to decide where you're going to have your meeting, how you're going to have your meeting. You get to decide who's going to come along for the trip. So, say your board is yourself, your spouse, your kids, and your sister and their family, right? And you say, hey, you guys are all on my advisory board for my company. We're going to hold a board meeting in Hawaii this year. And we're going to go do that. And it's going to be right around Christmas time. And that's great because we're just trying to get it in before the end of the year. And you get to use your company to pay for travels, for airline tickets, rental cars, meals, hotels. As long as you're doing an actual meeting and holding your board meeting and make sure that you take notes of who was there and what you talked about and all that kind of stuff. But you basically get to deduct your family vacation uh, by having it as a board meeting. So it's a really powerful thing. It's something that you can do. You can still do it if you have travel plans for this year. You just need to go back and change things around a little bit and say, hey, listen, this is what we're actually getting together for. So it's a pretty cool strategy. And it also helps you make sure that you keep your business up to date with your meeting minutes because you are supposed to do a meeting every year to talk about board stuff, right? When it comes to maybe some people are trying to get businesses started and you've spent money on, getting your website going or doing advertising or, getting logo shirts made or whatever it is that you've done so far. That's all great, and you'll get to deduct all of that eventually. But if you haven't made any money yet for this year, you don't have anything to deduct it against. So if you're trying to start up a business, what you really need to do before the end of the year is make a sale. And maybe that's just, hey, my brother's uncle, or what, I guess that would be your uncle, whatever. Like, just get somebody to buy your stuff so that you have income, so that you can start deducting all of the things that you've already spent money on. So if you're working on starting something up, just get to that point, make some kind of sale. Doesn't matter what it is. A big thing that everybody should do is take a look at your business structure for the year. And one of the most powerful strategies out there for business owners is the S Corp tax election. And if you haven't heard of that before, the idea is you can have an LLC and you can have it taxed as a pass through, right? So all that you're going to do is you're going to take your P&L and put it on a Schedule C and put it on your income taxes, right? And you can do that. You can also have your LLC taxed as an S corporation, which is saying, hey, IRS, I want you to think about me a little bit differently than just me running this business. I want you to really treat me like I'm a legit company. I'm a corporation. I'm doing payroll. I'm doing all of the stuff that goes along with being a business. And I want to pay taxes like that. And so your first thought is, okay, well, I don't want to pay taxes as a business, but as an S corporation, the first thing that does is it says, hey, listen, you are now an employee of your company. As a sole proprietorship or as a pass-through LLC, you're not an employee of your company. The company is you. Once you go to S Corp or C Corp, you can now be, well, you're now required to be an employee of the company, and you have to take a W-2 salary. And we can talk about what that means, because there's certain ramifications that go along with that. And we have a matrix that we use to decide what your salary should be in order to minimize your tax liability. But the first thing that does is it turns off self-employment taxes. And self-employment taxes are 15.3% tax. And that's a hefty number that you're paying on every dollar of profit that you made. So moving to an S Corp, it means you have to do a different tax return. It means you have to put yourself on payroll, but the savings on it can be tens of thousands of dollars. And just a little thing, the thing to think about when you're making enough money to do that strategy is when you're netting about $40,000 or anything north of that, that's when the equilibrium of the extra costs that go along with payroll and doing a tax return to the business catch up with the savings from self-employment taxes. So if you have a company and um, and you've made more than $40,000 for the year net after expenses, it's a good thing to consider. And you can actually do this for 2024. You can do a retroactive S election back to January and count the entire year as being able to do this. If you do, the most important thing to do before the end of the year is to get your payroll set up. And we can help you with that. If you're using QuickBooks, you can do it through QuickBooks. If you have a company that you know that does payroll, you need to get it set up before the end of the year and get your payroll taxes done through whatever mechanism that is. So the next really interesting thing for business owners is health insurance. And one of the things that you can do as an employee of your own company is you can offer to your employees, you, what's called an HRA, or a health reimbursement arrangement. Now, you only get to do this if you are an employee. Um, and this can work even if you have other employees. You can say, well, listen, in order to qualify for our HRA plan, you have to work 40 hours a week and you have to have been here for 2 years. Okay, great. So you can set up stuff like that. Um, but what you would do is you would put you and your spouse on payroll as W-2 employees, and you can set up your own customized arrangement of reimbursing yourself for uh, insurance dues, insurance, what do you call it? The co-payments, um, basically anything healthcare related, you can reimburse yourself, which then gives you the deduction as a business of paying for health related things for you personally as an employer. And it's pretty cool. It's definitely worth looking at. If you offer it to one employee, you have to offer it to all of your employees. But like I said, there's ways of setting it up where you can be kind of particular about doing that stuff. Okay. The next thing, and this is a really good one for the end of the year. It's a really good one to think about all the time, but you think about who's in the higher tax bracket, you or your kids. And if you want to pay overall, you want to pay less money on taxes, put some income to your kids. They're not going to pay taxes on that. And one of the best situations that you can find yourself in, having your own company and employing your kids, is up to the standard deduction. They don't have to file taxes at all. They don't have to pay anything. The standard deduction for this year is 13,850 if you're single, or 27,700 if you're married. So your kids would be under here. So almost $14,000 of income, they're not going to have to pay any taxes on it. And you're going to take this as a deduction. You pay your kids $14,000. That's $14,000 less profit that you made, and you're gonna move it to your kids. And even if they have a small job, you don't have to, you don't have to stop at the 13,850. They can make more money. They're still going to be in a lower tax bracket than you are. And overall, you're going to pay less taxes. One of the real cool strategies with your kids is use that to fund their Roth IRA. And for kids, if you can imagine, you're getting the tax deduction for paying your kids 14 grand. Your kids are getting that income tax-free. They can put it, because they're now employed. Once somebody is making money, you can have a Roth IRA, and they can take that 14,000 and they can put in $7,000 into a Roth IRA. You didn't pay taxes for it coming out of the company. The kids didn't pay taxes for it because it was under the standard deduction. It went into a Roth IRA, which was tax-free going in. It's tax-free growth, and it's tax-free when it comes out. And if you do this type of thing with your kids, and you can start on that early with your kids, even just funding it in its entirety every year. So this year it's 7,000. It's probably going to go up. Over the next couple of years, it seems to go up $500 a year or so. If you do this for your kids and they just keep funding it every year, by the time they get to retirement, you're going to have $2 million sitting in this bank account. But the other thing is, when you're doing Roth IRAs, there's so many different products out there. And one of the ones that I really like is called a self-directed Roth IRA, which means you can take that money and you can have checkbook level control over it, where you will just say, hey, listen, I want to invest in the stock market. Okay. I want to invest in my friend's business. Okay. I want to invest in a crypto farm. Okay. I want to invest in some rental property. Okay. You're just writing a check out of this, and now your Roth IRA holds on to whatever those assets are. And those assets are now growing tax-free. It's awesome. It's amazing. I'm thinking about, so I did this already with my kids. My kids are 4 and my son just turned 7 yesterday. So I have Roth IRAs for both of them. We're paying them a little bit because they're still young. They can't have, a full-time job or anything, right? But as I'm doing this with them, my intention is to get their Roth IRAs to the point that I can go use it and buy some rental property and actually have, by the time they get to the point where, they're 18, they're talking about college, they're talking about everything else, uh, they'll have property sitting there waiting for them, making passive income every year in their Roth IRA. And I could go on and on about this stuff, but there's some really neat strategies that go along with paying your kids. So it's definitely something you should think about doing. If you're going to pay a spouse or older kids, most of the time, if you're going to pay your spouse, don't put them on payroll. Most of the time, you're just going to give them, give them a stipend, give them whatever it is that you want to give them. It's going to count as a distribution from the company. But don't put them on payroll. The time to put your spouse on payroll is if you want to max out a 401k for them, or if you want to do the health reimbursement arrangement, and you can do that for your. Um, okay, so yeah, so reasons to pay your spouse. So older kids, it's a different thing, but of course you can pay your kids. If your kid is 20 and you want to teach them the business and have them working for you, go for it. Pay your kids. They're still going to be in a lower tax bracket than you, and to the greatest extent possible, you want your money to stay in the family, right? Okay. So moving on from business stuff is charitable contributions. And, since the Tax Cuts and Jobs Act, which was Trump's first time in office, and he made all of those changes to the tax laws, he really increased the standard deduction. So anybody who doesn't itemize, and the standard deduction has been great for most people, but it also means that you're not itemized, you're not getting your mortgage insurance stuff deducted. You're not able to take charitable contributions, all the things that you would get when you are itemizing. You basically lost access to because the standard deduction was so much. If you're still itemizing, then charitable contributions is something that is still accessible to you. Just make sure, so you can deduct up to 60% of your income. So AGI is adjusted gross income, if everybody remembers. And if you're doing non-cash donations, make sure you get receipts. And most of the time, if you're donating clothes or you're donating, furniture or something, they're going to give you a blank sheet. Make sure you put something on it. They're not allowed to put anything on it because they don't know what your stuff is valued at. But you do. And remember to do it while you're giving the stuff away, because you're not going to remember come next April or next October when you go to do your taxes and you're like, oh man, what was my charitable contribution like? Do it when you give stuff away. and make sure you being reasonable about what it is. Now, I do want to mention when it comes to charitable contributions, there may be some things that will look like charity, but you have to distinguish between things that are nice things to do and things that are charitable things to do. And what I mean by that is, so say for instance, um, one of your friends starts a GoFundMe account and their kid is having some medical problems and you put a bunch of money into a GoFundMe account to help them out. That's a nice thing to do. It is not a charity. So you don't get charitable write-offs for doing that. And that's, so it really is, it's kind of the test of, are you going to get credit for this thing or are you just being nice? And by all means, do both of them. Like do as much as you can give to people, right? Um, but GoFundMe accounts and private funds and things like that that are not actual charities, you don't get the deduction for doing that. Now, it would be a little bit different. So say your sister is in the hospital and she has a GoFundMe account, she's doing all of that stuff, and you want to give her money. If you give the money to the GoFundMe account, it's not going to count as a charity. However, if you go to the hospital and pay her hospital bills, that does count as charitable giving. So there's some different ways of doing it. Just consider what it is that you're doing and consider the characterization of it, because you want to make sure you're giving directly to a charitable organization so you get the deduction. Okay, so this one is a big one for people who have investments. And so say you have a year where you had a bunch of capital gains. Maybe you sold your house and you walked away with $100,000 that you're going to have to pay taxes on the capital gains for. One way that you can negate some of the capital gains is by having capital losses. So something that people can do, and when you have a bunch of investments, you can pretty much find something that has lost some money. You can harvest those losses by selling that particular investment to capture the loss and so say you sell something that's lost $10,000, you can then take that $10,000 and go apply it to the $100,000 gain that you had and net those out so that you're paying less money on it. And it's a great strategy if you just have a whole bunch of random investments and you can pick something that has been underperforming. One thing to watch out for with that is to avoid the wash sale rule. And if you don't know what that is, the idea is if you can take the loss, so say I had this thing, it lost $10,000 because of where it is right now, but I think it's going to go back up. So I'm gonna sell it now for a $10,000 loss, and then I'm gonna go buy it tomorrow, which changes my basis. And then as it goes back up, my basis is down here, and now I have all these gains, but I took this loss because it dropped for a little while. That is against the rules. So the wash sale rule is there's a 30-day restriction on it, which means if you go sell your Apple stock and you took a loss on your Apple stock, you can't go buy it again inside of 30 days. Otherwise, they're going to pretend that you didn't sell it and they're going to adjust your basis back to what it was originally. So just something to be mindful of if you're going to do this strategy. Okay, medical benefits. So you might not be able to, if you're not itemizing your deductions, right? You're really not able to do much as far as taking medical deductions. But there's still some other things that you can do in the medical benefit realm. And it's stuff to consider, right? So a lot of people, if you work for a company, sometimes with your benefit package, they will offer an FSA or flexible spending account. Um, these things are great as long as you use them. A lot of times, the company plans that people have out there, you have to use them by the end of the year, or a lot of them these days you have until like March 31st of the next year to use all of those funds. But otherwise, you lose the funds. And that was your money that you put into it. So you put it in to try to save money on taxes. But then if you didn't spend it, not only did you not get the tax benefit, you also just threw away whatever money you put into it. So these are great. The max is $3,200 that you can put in per year. And if you're doing it, just make sure that you are putting in what it is that you're going to use and you're not going to end up wasting it. A little bit different from an FSA is an HSA. So an HSA is a health savings account. And an HSA might be provided by an employer, but you can also do these by yourself. So you could go out right now and you can go to Fidelity, for instance, and you can set up an HSA account. Contributions to HSA are tax deductible, so that's tax free. But if you remember, we talked about on a 401k, it's tax free going in and taxed going out. On a Roth IRA, it's taxed going in and tax free coming out. On an HSA, it's tax free going in, it's tax free growth. And as long as you use it for medical expenses, it's tax free coming out. HSA is the strongest of all of those things that you can do. Now, there's also, again, just like the Roth, there are limits to this. So your limit that you can put in for a single person is about $4,000. For a family, it's $8,300. This is one of those things, and again, we're talking about end of year strategies. You can go set up an HSA account today and go fund it with the entire amount today, and it still counts for 2024. Now, when I say you can go set it up, there are restrictions on setting up an HSA. And the first one that you have to do is you have to have a medical insurance plan that is a high deductible healthcare plan. And when you look at, say you're looking at an employer benefit program, they offer the bronze, silver, and gold plans, right? The bronze plans are the high deductible healthcare plans. It's a similar thing through the marketplace. If you're going to go through our Texas marketplace, for instance, you're looking for something that is a high deductible healthcare plan. If you have a silver and gold regular healthcare plan, you don't qualify to do the HSA. So, and if anybody wants to get more in depth with that, we can do that too. All right. Family and estate planning. So, I know that there's some people who like to give gifts at the end of the year. I just wanted to have a little reminder here. There's an $18,000 per person limit on gift giving. It doesn't particularly help you in taxes. The only thing it kind of does is reduce your taxes, your taxable estate. But your taxable estate at the end of the day, unless you're passing on to your kids millions and millions and millions of dollars, the annual gifting, it all goes towards that limit at the end. So it doesn't really get you anything, but if there's a reason that you're doing gifting for people, it's totally fine. Don't go over $18,000 per person. If you do, you have to fill out a gift tax form, and then you got to report it on your taxes. They got to report it on their taxes. So just be aware that if you're doing that, that's the limit, $18,000. Also family stuff, talking about college savings. So there's a couple different things that are out there as far as college savings. If you wanted to start one of these and fund it before the end of the year, there's still time to do that. And you can, and these are both tax-free accounts that you're setting up. So a 529 plan, there's higher limits on that of what you can put in. But there's different rules for these things. So a 529 plan is a state fund. It's particular to the state that you are living in and paying into. And some states have rules where they say, hey, you put $50,000 into a savings plan. You have to use it towards a school in our state. They don't all do that. The rules are all different because it's a state by state kind of a thing. So just be aware if you're going to do a 529, there are some special rules that go along with it. Now, that said, if you're sending your kids to a school that is going to be expensive, the 529 plan has a much higher limit of what you can contribute. The Coverdell plan has it's a bit more free when it comes to things that you can spend the money on or how you can transfer it to different people, but you can only put in $2,000 per year into a Coverdell. So, if you're planning on spending $150,000 on your kid's education, well, you're only going to be able to put in $2,000 a year into this thing. It's not going to take you very far, right? So, but that these are things that you can still do for this year and be able to dump some money into that. That's going to be tax free. The other thing to consider, and this is it's a kind of advanced strategy when it comes to charity and estate planning, is a charitable remainder trust. And what you can do with a charitable remainder trust is pretty cool. You you set it up where you're going to fund it with a bunch of money, and you can fund it over a certain period of time where you say, hey, I'm putting in $100,000 a year or something into my charitable remainder trust. And then you set up the other side where you're going to pay yourself or a family member, for instance, for running the trust and the charity. And what you end up doing is at the end of the life cycle of the trust, whatever is left in the trust is going to go to the charity that you chose. But the strategy there is to figure out how much money would you fund this thing with and how much money can you take out of it as a salary, each year for the next 10 years or so, where you're going to get a big bump on tax savings now, and then you're going to take it as income over time and maybe not have that much left in it at the end of life. Like, hey, most of it got used up in us running the thing, and um, your charity gets maybe $5,000 at the end of it, and you got tax savings for 10 years out of it. So it's a thing to consider. It's on the advanced list of strategies, I would say. All right, so the last couple things on our list, the Augusta rule. So again, this is a great little thing for business owners. The Augusta rule lets you rent your house out, your personal residence, lets you rent it out for up to 14 days each year. And if you're, say, going to host a Christmas party for your company, rent your house out to your company. It's at fair market value, which, and to get that is really easy. You go to Zillow or Redfin or something where it says what your house would rent for if you were renting it on a monthly basis, right? And you just take that, divide it by the number of days, and say you rent it out to your business for 2 days for doing a holiday event or meetings or whatever it is. That income goes to you. So it's a business deduction. but then the income comes to you and you don't have to pay taxes on that as long as you follow these rules. Now, if you do it for more than 14 days, then you start getting into a situation where you now have to pay taxes because you're renting it out to people. So stay within the 14 days. It has to be a personal residence. It can't be a rental property or a commercial property or something that you own. This is just for personal residences. But it's pretty cool. So you can get some tax-free money out of that too. And it's perfect because end of the year holiday party, hey, have your staff over to your house and do the party there and save some money. Buying rental property. So we're getting close to the end for this, but if you're working on this right now, or if you already have rental property, there may be some things that you can do to pull this off before the end of the year. So if you're just buying something, uh, it's probably going to be tough unless you're turning it into a short-term rental. It's going to be tough to get any particular tax savings out of it. But if you already have a property and you're like, hey, I needed to, like, we're going to have to replace the air conditioning in April, go do it now. Make some repairs. Hey, we have to redo the flooring. Great. Go spend the money on it. And you're going to take that loss because hopefully your rental property is already a paper loss. Um, if it's not, it should be. And that's something worth looking at and maybe figuring out how to do depreciation or maybe do a cost segregation study in order to front load some more depreciation. But you really do, most of the time, you want to have your rental properties on paper showing a loss. But take the loss this year. And that's a thing that you can still do. So go hire somebody to replace your carpets really quick and get that done, or change out your windows, or whatever it is, right? And then the last thing that I'm going to say is, paying taxes is one thing. Paying penalties and interest on taxes is a whole different thing. And it stinks to pay your taxes. It stinks more to have to pay extra money on top of your taxes because you didn't pay your taxes. So go through, if you've made quarterly payments during this year, make sure that you're trying to get to the right amount. Make sure you've done them on schedule. Pay your estimated taxes because if you can avoid the penalties for missing deadlines, you're gonna like that's money saved, right? So go through, check out everything that you've done so far, see if you need to pay anything else, and pay it before the end of the year. Get it on the books for this year so that the IRS isn't going to be upset with you. Yeah, I think that's about all that we have on the schedule to talk about. So why don't we open it up to some questions? And oh, if well, I'll leave this up while we're talking, but again, if you're not on our newsletter, go ahead and you can sign up here. We do have a YouTube channel going now where I'm loading up informational videos. I'm really excited. We're going to do some more. If anybody has gotten lost on YouTube, um, those little doodle videos where they explain stuff. We did one of those. I have two more in the works right now. I just think those are the coolest thing. We're going to do a bunch more of those. And, hopefully that will be where we have a lot of content for you guys. And follow us on social media. Okay. So, questions. Family members, does this apply to grandchildren? Okay, that's a good question. So, when it comes to paying your kids, we're talking about paying your kids. If you want to pay grandkids, the way that you do it is to pay your kids and let your kids pay the grandkids. the way that the provisions work, it doesn't really cover grandkids as part of the codes. But it's really easy. You just say, hey, Bob, I need you to give this to your kid. Here's $1,000 because they helped me with blah blah blah. Okay, great. So you give it to Bob. Bob puts it in his family management company, and the family management company pays the kid. So the family management company has plus 1,000, minus 1,000, same thing. And it still gets to the kid. But that would be the way to actually do that, is to pay your kids so that they pay your grandkids. Anything else you got? Okay, well, now's the time. If anybody has specific questions, how do I? Oh, I guess I will take off my sharing. All right, let's see. Extended grandkids. Okay. Can you depreciate your equipment 100%? Rimu, what kind of equipment are you talking about? Embroidery machine. Um, Gosh, what's an embroidery machine cost these days? So there's a couple different ways of dealing with that, right? Um, if it's something that costs a couple of $1,000s, you can just take it as an expense. If you have the income to put it against, just expense it instead of depreciating it. And then, yeah, you got 100% of the deduction for it. If you want to take it over years, or if you're talking about, this thing is $20,000, $30,000 and it makes sense to depreciate it over time, what you're going to be trying to pull off is bonus depreciation for that. And bonus depreciation for 2024 is 60%, and it's going down by 20% every year until it eventually phases out. Now, that's something that might change with the Trump administration coming back in. They really liked bonus depreciation, and I think they wanted to make it a permanent thing. And if that were the case, then yeah, you could bonus depreciate, within whatever their guidelines are, 100% of your stuff you can front load it. I would say probably, again, I don't know what an embroidery machine costs, but if you're really trying to take all of it 1 year, just take it as an expense instead of putting it on your books as an asset. I think I can, if anybody wants to just speak questions, I think we can turn on microphones one at a time. Just raise your hand and I can do that. I think I can do it. Let's find out. All right, Rimu. See if we can hear you.
Hello,
Hey, how are you?
I'm doing well. How are you?
Good, good.
Yeah, thank you for all the information that you just shared today.
Yeah, hopefully everybody found that useful.
Yes,
I was gonna post the whole video of this, although with the technical issue,
yeah, no worries,
I don't
no
know. We'll
worries.
see how that works out.
Just a last question. I have like because I just bought this store, right? And on my books, it's basically the cost of the machine is probably 50, $60,000 on the books.
Okay.
So and they are old machines, you know. So the life is pretty much done. So they are probably 20 years old. So I was just thinking to have a bonus depreciation taken this year, which you said like 60% of it. Can I do that?
Did you buy them from somebody else? Like, are these machines new to you?
Yes, they are new to me because I
Okay.
bought the business
Okay.
and they came with the business.
Okay. So when they came with the business, you would have had some type of value associated with them, or when they came onto your books, did they come as fully depreciated, zero value?
No, no,
Okay.
they had some value.
So whatever the value is that happened during that was recorded during that transfer,
Right.
yes, you can depreciate that.
Okay.
Um, but if it was a $30,000 machine and 25,000 of it had been depreciated, you only get to use 5,000 of it to depreciate forward.
Right. Right. No, it was because in the prior owner's books, roughly 50, $60,000 were pertaining to machineries.
Okay.
So if
Yeah.
it's
So so the best you're gonna get depreciation out of that, and there may be certain rules for different classifications of machines, although as long as it's new to you, I think you'll be able to do the bonus depreciation. And for 2024, that's 60%. So
okay,
you're not going to be able to claim 100% on it, but you can claim 60% on it.
okay, got it. And then the next year you can do the same.
The next year and moving forward, you're going to be so if the lifespan of the machine is 10 years, 15 years, whatever it is, the 40% that's left over, you're going to be depreciating over that schedule. So say it's 10 years life, um, the just for easy math, right? It's $100,000 piece of equipment. You're going to depreciate $60,000 of it this year. You're going to take 40,000 and you're going to appreciate 4,000 a year over the next 10 years.
Okay, got it. Okay, got it.
Cool.
Yes. Thank you.
Okay.
Thank you.
Well, if nobody has any other questions, I guess we can wrap it up and I'll give you guys back 23 minutes of your day.
Thank you.
So, okay. Well, I hope everybody has a very Merry Christmas and we'll see you again soon. I'm going to try to do some more of these webinars. So watch out for our emails. I'm going to try to do at least once a month on interesting tax topics and accounting related things. So, okay. Well, thanks for joining everybody and we'll see you next time.